How's that helicopter flying over? I'm Angela Brandt. You've been watching the Homegirl channel. I'm Angela Brandt. Welcome to the Homegirl channel on YouTube, where it's about real estate, education, who knows, maybe an occasional bottle of wine. We are going to talk today a lot of it about student loan debt, forbearance, all these other terminologies that you will hear as a person with some really heavy student loan debt. I am very happy today to have Chris Banyay with Prime Lending with us. Yay, Chris! I like to actually call him Chris Ben. Yay! Chris, welcome to the show. How are you?
Fantastic. Thanks for having me.
Good, good. You are sort of my resident expert on student loan debt. So today, for once on this show, someone else is going to do all of the talking, and I'm going to just start out with this story. You know that my client base is pretty much millennials. And a lot of folks are saying that millennials don't buy houses because that's just sort of their personality. They don't want to. They're just, they don't feel like buying a house. There's another flip side to that, and I need to read this because it was a recent study by the John Burns Real Estate Consulting. They estimated that the heavy college debt will reduce real estate sales by 8% for this year of 2016 among that millennial age group. Meanwhile, the Federal Reserve Bank of New York found that for the first time in at least a decade, households with student loan debt are less likely to have a mortgage than those without student loan debt. Mortgage rates right now are at historic lows.
Yeah.
Everyone who can afford a house should be buying a house.
Absolutely.
Every day I talk to people that say, but I have this student loan debt. They walk into my office, how does my client's student loan debt, how does that affect their credit score, Chris?
Yeah, it makes a significant difference. Your credit bucket is filled up with installment loans, mortgage loans, credit card debt, things like that. And installment loan is a component that's heavily weighted for your credit score. So
I believe that's 35% or something ridiculous.
Yeah, it's a significant number. So the folks that have student loan debt and have a significant amount of student loan debt historically didn't believe they had the ability to buy a home. Up until October of 2015, the FHA guidelines, and I'll speak to FHA because they're the most flexible when it comes to student loan debt.
Right.
The FHA guidelines said that if you had student loan debt, it had to be calculated in your debt-to-income ratio as whatever that payment was. So for example, if I have $45,000 worth of student loan debt and my total of my payments is, say, $475, that's the number that I as a lender have to use to qualify you for a mortgage.
Okay.
So recently they changed that, and they came up with a plan that said, okay, we understand that student loan debt is limiting the millennials' ability to buy a home.
Oh, absolutely. I see that every day.
So there's a program that's called income-based repayment, and it's a fantastic program for first-time home buyers that have significant home loan debt. Mm-hmm. And I guess the best example will be they take a look at your income, they take a look at your assets, your liabilities, and then they calculate, okay, this is what's a normal and reasonable payment for these people to be able to make.
Okay.
So for example, a $45,000 student loan debt might be $475 a month. However, if I make $35,000, which as a first-time employed person, that's pretty realistic for me, I can go into the IBR program, and IBR stands for income-based repayment, and qualify for a payment of about $147 a month. Now that my payment's $147, that's the number that I, as a mortgage lender, am going to use to qualify you for a mortgage.
So we have this bucket of millennials that come in, and they've not been able to find a job that pays them enough to qualify for a mortgage based on their student loan debt. Mm-hmm. Does that fall in that IBR?
It does, and again, that goes back to the best example for the IBR is, the economy isn't spectacular right now. It is a little bit difficult for recent college graduates to be able to find a job that pays them what they thought they possibly were going to earn after they graduated from college. So what they can do is they can go back to their student loan company, and there are all kinds of calculators on the government's website. Studentloans.gov, I believe, is the website.
Okay. You
can go there, and there's an actual calculator. It says, if I make X, if my other liabilities are Y, if my income is Z, this is the amount of payment that I can afford. You can then take that calculator and then go back to your student loan servicer and say, I'd like to qualify for the IBR program. I do believe I meet the criteria. Here's the beautiful part for the IBR program. Let's say you enter into the program and after 20 years, you've made your payments, your income has changed, your monthly payment will change as your income
As your
changes.
income changes, okay.
If your income goes up, then your payment's going to go up. However, I qualified you for your mortgage on the number that I used when you bought your home 2-3 years ago, so that doesn't impact your mortgage. However, it might impact your ability to pay. But let's assume that after 20 years, you've never been able to break the glass ceiling and get away from that job that pays you $35,000 a year, and you haven't really hit the majority of your student loan debt. It's forgiven. You don't have to pay it back.
Okay, so there's a program out there that will allow me after X amount of time to stop paying my student loan debt.
It's forgiven.
It's forgiven.
Yep.
Okay, so when folks talk to me about their student loans, there are two terms that I don't particularly understand, and those two terms are forbearance and deferment.
Mm-hmm.
Can you please define and expound upon those two?
Yeah, absolutely. Deferment is the most common of the two. Everybody has deferment when they graduate from college. So when you graduate, you have a 6-month deferment period where you have the ability to hopefully go out and get a job, get your feet wet, get your apartment, whatever it might be, hopefully buy a house, and then go ahead and start making your payments on your student loan. Under the current program, you used to be able to go and get deferment for up to 12 months. Okay, so if you were in deferment for 12 months, I didn't have to calculate that debt against you against when I was qualifying you for a mortgage. Forbearance is still available. Deferment's no longer available for that 12-month period. Forbearance is. The downside to forbearance is I still have to calculate what your payment's going to be even if you're in forbearance. So let's again go back to my example of a $45,000 loan. If you're in forbearance and you don't have to make your payments because it's called financial forbearance, I still have to count that in your debt to income ratio, even though you don't have to pay it back at this time.
So if I have a choice, if I have a lot of student loan debt, I really want to go into that IBR program.
Absolutely.
And I want to avoid forbearance at all costs.
Absolutely, yes.
Because I've had several other professionals in the last few months tell many of my clients, go forbearance.
Mm-hmm.
And I don't understand that. And I'm not very up on that side of the rules and the regulations. But that is just one thing I never understood. Or I've had mortgage lenders say to a client, well, go back and take another class, take out more student loan debt, and then we can defer these and we can use all these other different numbers. Is all of that kind of nonsense since they changed
Yes.
these rules, that all that craziness is
Yes,
off the table?
all that craziness is off the table. And keep in mind, if your loan was in forbearance, the interest clock was still ticking.
Oh, absolutely.
So it's not like you got a free lunch. You're still going to have to make those payments at some point in time.
Okay, so it's not like the pay your student loan. I'm still hung up on this. It's forgiven
Yeah,
after X
it's
amount
crazy.
of time. I mean, that is just incredible. I want to go back and get my master's degree now and take out a bunch of student loans. Not really, but anyway. So if I'm in this IBR program, if my income goes up, my payments are going to go up. Is that pretty much the way it goes?
Yeah, so
Okay.
they're going to recalculate it every year. You're going to
Okay.
have to turn in your tax return and show. Now, well, the one thing we haven't talked about is there are people that got their college degree and have significant student loans, and maybe they went to a private school and financed the whole thing. If based on their IBR, the payment is zero, and we have a statement from their student loan company saying it's zero, I use zero to qualify you for your mortgage loan. And I have 2 folks I'm working with today that's the exact situation that they have.
So what is there a baseline of that number, 120, 150, 80?
Yeah, honestly, it's an algorithm. So the
Okay.
only way to find out your number is to go to the website, plug in your number, see where you are, and then reach out to your student loan company to see what you might qualify for.
Okay, what is that website again?
Probably the best one is actually just Google's guaranteed student loans, and it'll
Okay.
take you straight there.
Great. Now, what about some of these companies that service student loan debt? And I had this happen last year. A client called, and the servicing company said, no, I think for you, in order to buy your house, the best route to go would be forbearance. If you're talking to some of these companies for your student loans, these servicing companies, I just tell them, hang up and keep calling back until you get someone who knows what they're talking about. And I don't mean to be rude or disrespectful to any of the servicers that are out there, but some people that answer the phone could be better than others.
Yeah, absolutely. If you get an answer that you don't believe is correct or you don't think is the logical answer, yeah, absolutely call back. But also reach out to your financial professional. Ask them. I deal with this on a daily basis, whereas you might be making one phone call every 5 to 10 years to talk to somebody. I do this once a week. So reach out to someone like myself, a qualified mortgage professional, and let them help you. That's what we get paid to do.
Right. And I always tell people that say, oh, I've got student loan debt or I have this or that. Pick up the phone, call me, call your bank, call another mortgage professional, call Chris. I don't know his phone number off the top of my head, or I'd give it to you. But I always say, find out what your baseline is.
Yeah.
I was talking to a friend of mine in Richmond, Virginia last night, and she was talking about all of her student loan debt. And I said, let me be the first one to tell you, find out what your baseline is. That is so important because at least you have a starting point. You know where you are, and correct me if I'm wrong, Chris, a lot of most mortgage professionals can help you go from that baseline to now you qualify for a home mortgage.
Yeah, absolutely. If you're dealing with an experienced mortgage professional, and for example, let's say you've got a 580 FICO score, which is not high enough to be able to qualify for a mortgage in today's world. But you speak with your mortgage professional, they can take a look at your credit report. Typically, there's no cost for this, and if someone's asking you for a fee, go to someone else. Run screaming, go contact somebody else. But let them pull your actual credit report, take a look at it, and then we have different mechanisms that allow us to do what-if scenarios. So, for example, I can take a look at your credit card debt, your car loan, your student loans, and I can say, okay, you've got X amount of dollars in credit cards. If you pay down this one to Y, this one to Z, pay this one off, pay off this collection, your score will go up 30 or 40 points. And I'll give you a number that'll be pretty darn accurate.
That's pretty cool.
Yeah. And it's not just me and Prime Lending. It's something that, again, any qualified mortgage lender can do. Some mortgage lenders are more aggressive than others with their ability to help you. So you might call your local small bank and they might say, well, we don't do anything like that. There are other people. Call your real estate professional, say, who do you recommend that I contact and that could help me to eventually be able to buy a home? I've been doing mortgages for 28 years now and I've never told a person no. I've told everybody not yet.
Not yet.
Qualify. So everybody's a potential buyer, but if we put them on a path, which I'll do, I'll work with them, I'll take a look at their credit, and I'll lay things out, and I'll say, if you do X, Y, and Z, if your ultimate goal is to be able to buy a home, then you're going to be able to. But if you choose to do X, and then go buy a new flat screen TV because it's cool and you wanted 4K and smart TV and all that, that's your own business.
Right.
But if I put you on a path and you stay on that path, you'll be a home buyer within a fixed period of time. Now that time might be 3 months, it might be 6 months, it might be 12 months. But I have people that I've had in my program for 2 years now that are actually buying houses today.
Yay, that's awesome. That's fantastic. Chris, what else do you want to talk about with regard to student loan debt, DTI? That's a great number. I go, oh, DTI. Everybody knows that's debt to income, but not really. But is there any other sage advice that you'd like to give folks that do not believe that they would qualify for a mortgage because of their student loan debt?
Yeah, absolutely. Don't stop with your first person. If your first lender says, no, you don't qualify, get a second opinion. You're buying a home, which is probably the largest purchase you're ever going to make in your entire life. If you're going to have open heart surgery, are you going to get 2 opinions or are you just going to get 1?
Okay.
Probably get 2. So get a second opinion. If somebody says you only qualify for a mortgage of $140,000 because your debt to income is 42, that might not be accurate because different lenders have different criteria.
Right. Those different overlays really make a world of difference. I found out about those.
Yeah, so if your lender says you only qualify for X dollars because your debt to income is 45%, we've now seen the agencies open up, both Fannie Mae and Freddie Mac, to where we're getting loans approved with a DTI, or debt to income ratio, as high as 52 to 53%. Now, when you get to that level, you have to be a little bit more cautious because there's a reason that the agencies say, this is basically what you qualify for. But you might have a reason that makes sense for you. Maybe you're buying a home with a boyfriend, you're going to get married, but he's not going to be on your loan, and he has income that's going to be going into your household in the next 2, 3, 4 months, then it makes sense. If it's a single person working a job with no ability or without the possibility of seeing their increase dramatically, I would take a look at it and maybe stay away from that. I don't want to be house poor.
Correct. Okay. That's what I love about you, Chris. You don't. You and I operate very much the same way. Is when you look at someone's overall picture with their money. you may be able to qualify for a $200,000 mortgage, but your quality of life is going to be non-existent. So if you're, going skiing once a month, or I'm sorry, I love that. If you're going on a, week-long ski trip, or, if you're doing a holiday every, 2 or 3 times a year, and you go buy a house, being house poor it's a horrible place to be.
Yeah, especially with first-time home buyers, we take more of a consultative approach. We try and ask the question, where do you want to be in 3 years, 5 years? How long do you want to own this home? Before we say, hey, this might be the best product for you to take a look at, we'll do a consultative approach and say, okay, based on what you're telling me, you might want to go with a product A versus a product B, and then we'll lay those out side by side, and then ultimately let the customer decide.
Right. Yeah. You and I are actually working with a client right now, and I just want you to know, I'm hoping they write on this house. However, they were very cute. They said, oh, we just don't know if we can afford this. And I said, have you spoken with Chris yet? Because I think that you do. So that was very funny. But their very first comment was, we just don't want to be house poor. And I said, I assure you, between myself and Chris, we will not allow you to be house poor.
I love customers like that. And just in your specific example, I know what their debt to income ratios are, and they're below what the government says is really the maximum. So I would go back to them and say, statistically, you guys are good. And they also live a conservative lifestyle. So, it's easy for me to go back and say, hey, look, I'm not concerned about you at this point in time. Now, again, if you go buy a new car tomorrow or 2 new cars, then your picture is going to change. But if you live the lifestyle you're living today, you're okay.
I'm Angela Brandt, your homegirl, educating you on your student loan debt. Thanks for being here. Enjoy your education on student loan debt. And thank you, Chris Banyay, for being here today. It's been my simple pleasure. And subscribe, watch, share, and I have a challenge for you. I would love to get to 1,000 subscribers sooner rather than later, because we would like to go big time. Go big or go home. See you next time.